Unemployment for college-educated people is 4.7%. 4.7%. We have full employment. And unemployment, again, it's a social issue. If we have 90% employment, but companies are making money, as investors, if you take off the kind of person hat, and now you're an investor, that's what we want. Better corporate profits. And guess what? Corporate profits are the highest they've ever been in history right now. Corporate cash, highest it's ever been in history. There's $1.8 trillion companies are sitting on. They're not spending it because they're waiting for some clarity on government policy. What are they going to do? Who knows? But I would suggest to you that as we get closer to next year, once the election, we have an idea who's running, we're going to start to get some clarity. The markets hate uncertainty. We've got a ton of uncertainty. So stuff goes up and down, up and down. Once we know the direction, I think we'll get some traction. This money will start to be deployed, and I think you'll see some very, very strong growth. Short term, we'll continue to have volatility. But does it really matter? If there wasn't TV and radio, would you guys think there was a recession? No, that's Black Friday. People are knocking each other. Somebody got tasered someplace trying to get toys. So if you go out to eat on a Friday night, are restaurants empty? No. People are spending money, and you guys know that, and you can see it. I think short term, we're going to have a lot of volatility. It doesn't matter. Our investment philosophy is a long-term, diversified approach where you should always have enough cash, short-term investments to weather the next 12 to 18 months. But I truly believe the next 3 to 5 years could be some of the best we've seen for the markets in the last 20 years. I don't think I've ever said that. And you look at the numbers, and they're phenomenal. The most dangerous words that we hear are, this time it's different. And what happens is, if people invest emotionally, as opposed to logically, we fall into the same trap. Everybody knows the idea, buy low, sell high. But that's tough to do. Because when stuff's low, so everyone tells you the world's at you. So what happens, we get in this confidence cycle. Yeah, I've already made some money, this is great. Then people get euphoric. It's like 2007 or 2000. All the dot-coms are going to go up. It's a new paradigm. It's a new economy. Then it starts to come down. Like, what happened? I'm not supposed to lose money. Then people get desperate. I don't care if I don't make money. I just want to stop losing. And then finally, they're defeated. Skip me out. I'm not saying any of you, generally speaking. Truthfully, our clients in the last downturn, really we did not see the panic. And for the most part, people are either holding tight or investing. And from the bottom, just March of '09, the market's up about 60%. And then it starts to go up. There's always going to be bubbles and things. It's always crises. The Cuban Missile Crisis, JFK, 9/11, Y2K, global flu, the swine flu, this, that. It's always something. But the fact is, the markets will always return to fundamentals. Now, I'm not saying everything's going to be perfect. I think we're going to see stronger inflation, and I would suggest to you, despite what the government has said, inflation is 7 or 8%. How many of you feel you're spending more on groceries? Yeah. How many of you paid more for the last car you bought than the first house? Yeah. Here's where the government kind of tricks you. They measure inflation by something called CPI, the Consumer Price Index. The Consumer Price Index does not include energy costs. It's only 14% food. It's 42% housing. I don't know about you, I buy more food than houses. And so, for the last couple of years, housing prices keep dropping. The government can tell you inflation's nothing. No increase on Social Security, no big interest on the debt. But if you take housing out, inflation's 7 or 8%. And I think it's going to get worse. I think taxes are going to get worse. And I think people are living much longer. The reality is, for a couple age 65, there's a 75% chance that one of them makes it to 86. There's a 25% chance one of them makes it to 97. How many of you know somebody that's age 90 or older? It's a lot of hands. When I started, we didn't have any clients over 90. 80-something was considered, really old. 90 is like the new 70. But the problem is, the risk is we're living longer, we're staying active, our money has to continue to grow. We can't invest with the rules of our parents. We can't just sit and not take into account inflation. And that's why, even once we're 70, 75, 80, we need to have some of that growth. Taxes today. Taxes are some of the lowest they've ever been. We already saw the taxes. We think taxes are going up. So we need to look at that. Next year's an election year. Since 1928, there have been 21 elections. In 18 of those years, the markets have gone up because people have hope. There's clarity. Now, in 2008, the market dropped 37%. There's always exceptions. I can't tell you what's going to happen day to day. If I could, I'd be somewhere else, doing something else, on my yacht. But long term comes back to fundamentals. Short term, it's perceptions. And today, we have this divergence where the perceptions are not in line with the fundamentals. And that's a huge opportunity. And we need to allocate based upon our needs, our objectives, and the long term. So, our philosophy stayed the same. Diversified long-term approach based upon your needs, your objectives, and your risk tolerance. We work as a team. In our office, there's now 14 people. We have 5 financial advisors. You can speak to any of them at any time. I also need to thank all of our spouses who support us, because I know everyone in my office works exceptionally long hours. And they couldn't do it without the support of their spouses and significant others, myself included, certainly. Assisting us are licensed assistants, Bobby, Rachel, Nancy, and DeJane. And there are client service associates, Deanna, Marge, Tiffany, Amanda, and Rachel. Or Becky, excuse me. I heard that. I got your picture up there. She'll be happy. At lunch, I forgot her picture. So, please feel free to call any of us at any time. I truly think people are going to look back down the road and say, well, I wish stuff was as good as 2011, 2012. I mean, hindsight's always 20/20. And it's certainly with a little bit of rose-tinted glasses. Please please take advantage of all of our resources, whether it's the web page, the social media, the staff. Come in for reviews, ask us questions, our seminars or events, those types of things. And if you have questions, contact us. I do think people, again, are going to continue to live longer. I think they'll be more active. I think the risks we face certainly are inflation and unreasonable expectations. But the opportunities that we have today are some of the best that we've ever had. You know, the past few years have presented investors with a number of challenges. And they've also provided opportunities for those who've had the tenacity and the courage to stay focused. That's true today too. You know, we look forward to being your partner. We look forward to sharing your vision, and we appreciate your business. So, thank you. Now,